You know that feeling when you stumble upon a stock that's about to explode? Well, get ready because we're about to uncover a hidden gem that could be the next big thing. You wouldn't want to miss out on the last opportunity like this, and you certainly wouldn't want to miss out on the amazing products from Amazon. But before we jump in, let's set the stage with a story that's sending shockwaves through the automotive industry. Rivian, the electric vehicle upstart, just saw its stock skyrocket by a hopping 32% after hours. What's behind this sudden surge? Well, it turns out Volkswagen has some big plans for this EV newcomer. We're talking billions of dollars big. But here's the kicker. This deal isn't just good news for Rivian. It's a game changer for both companies. And we're going to break down exactly why this partnership could reshape the entire automotive landscape. Now you might be thinking, wait a minute, isn't Rivian still struggling to turn a profit? And you'd be right. But that's where things get really interesting. We're going to dive into the numbers and show you why this deal could be the lifeline Rivian needs to become a major player in the EV market. But that's not all we've got on the docket today. We're also going to tackle the housing market conundrum that's got everyone scratching their heads. Bank of America just dropped a bombshell, predicting the market will remain stuck until at least 2026. We'll break down what this means for homeowners, potential buyers, and investors alike. And if you think that's exciting, just wait until you hear about the beauty brand that's poised for a potential 10x return. This under-the-radar company could be the next e.l.f. Cosmetics, and we've got the inside scoop on why it's catching the attention of savvy investors. So whether you're a seasoned stock market veteran or just dipping your toes into the world of investing, this video is packed with insights you won't want to miss. All right, let's dive in and start with the Rivian-Volkswagen deal that's got everyone talking. Volkswagen has just announced plans to invest up to $5 billion in Rivian, starting with an initial investment of $1 billion. This news sent Rivian's stock soaring, but the real story here is what this means for both companies. For Volkswagen, this deal is crucial. Despite being one of the largest automakers in the world, VW has been struggling to gain traction in the EV market. Last year, they only captured 4.6% of the global battery electric vehicle market share. That might sound decent, but for a giant like Volkswagen, it's simply not good enough. VW knows that the future of the automotive industry is electric, and they need to ramp up their EV game fast. By partnering with Rivian, they're gaining access to cutting-edge electric vehicle technology and expertise. On the other hand, Rivian desperately needs this deal too. The company has been burning through cash at an alarming rate. In fact, they've been losing over $100 million per week for the past 2 years. That's a staggering amount of money, and it's not sustainable. But here's where it gets interesting. Rivian has two major problems. They need financial help, and they don't have a mass-market vehicle. Volkswagen can potentially solve both of these issues. They bring deep pockets and decades of experience in producing affordable mass-market vehicles. This partnership could be the key to Rivian developing their own Model 3, a more affordable electric vehicle that could help them reach profitability and compete with the likes of Tesla. Now, you might be wondering, is this deal enough to make Rivian a good investment? Well, in the short term, we could see Rivian's stock climb to $20 or even $30. But the real test will be whether they can leverage this partnership to develop mass-market vehicles and achieve profitability in the coming years. Now, let's shift gears and talk about something that affects almost everyone, the housing market. Bank of America just released a report stating that the housing market will remain stuck until at least 2026. This might sound like doom and gloom, but it's important to understand the factors at play here. First, let's look at the current state of the market. Mortgage applications are near all-time lows, yet home prices just hit a record high in April. This creates a problematic situation where potential buyers are priced out of the market, but existing homeowners are reluctant to sell. So what needs to happen to unstick the housing market? The key lies in mortgage rates. Over the past 15 years, people have become accustomed to rates between 3% and 5%. But currently, rates are significantly higher, hovering around 7%. For the market to really get moving again, we need to see mortgage rates drop below 5%. But when might that happen? It all depends on the Federal Reserve's actions. The Fed is likely to start lowering rates sometime between September and November of this year. However, it's important to understand that there's not a direct correlation between Fed rates and mortgage rates. It's more of an indirect relationship. Based on current projections, we might see mortgage rates around 5% by 2026. This aligns with Bank of America's prediction and could be the catalyst that finally gets the housing market moving again. Of course, a major recession could throw a wrench in these predictions. In that case, we could see rates drop much faster, but barring any economic catastrophes, the housing market is likely to remain in a frozen state for the next couple of years. Now let's talk about a company that's been making waves in the stock market lately, the Honest Company. Founded by Jessica Alba, Honest has had a rocky journey since going public. But recent developments suggest this company might be on the verge of a major turnaround. Honest stock rallied 4.8% in a single day after Luke Capital upgraded it to a buy rating. But that's just the tip of the iceberg. When we dig into the financials and compare Honest to its peers, we uncover a potential gold mine for investors. First, let's look at the price-to-sales ratio. Honest is trading at an incredibly low ratio compared to industry giants like Procter & Gamble and Kimberly-Clark. We're talking about a 6x difference here. This suggests that Honest is severely undervalued relative to its peers. But it gets even more interesting when we look at the company's potential growth. Under new leadership, Honest has been rapidly improving its gross margins and keeping costs down. If they can continue this trajectory and reach profit margins similar to Procter & Gamble over the next few years, we could be looking at a 10x return on investment. Here's the math. If Honest can reach about $500 million in revenue by 2027 and achieve a 20% net margin, they'd be looking at $100 million in net income. Apply a reasonable P/E ratio of 25 in line with its peers, and you're looking at a $2.5 billion market cap. That's 10 times its current value. Now you might be thinking, this sounds too good to be true. And you're right to be skeptical. But consider this, Honest fits into a category of companies that often fly under the radar of many investors. These are what we call put-me-to-sleep companies, brands that focus on everyday products like baby wipes, diapers, and beauty items. Many investors, especially men who make up the majority of individual stock buyers, often overlook these companies because they can't relate to the products. But history has shown that these boring companies can deliver extraordinary returns. Just look at the performance of stocks like Elf Cosmetics or Lululemon over the years. So is Honest the next big opportunity in this space? The potential is certainly there. But as always, it's important to do your own research and consider your investment goals before making any decisions. Now let's talk about a topic that's near and dear to many investors' hearts, portfolio management. Specifically, we're going to look at how to handle a portfolio that seems stuck in neutral. Many investors find themselves in a situation where their portfolio value seems to plateau for extended periods. It can be frustrating, especially when you're seeing headlines about record-breaking market highs. But before you start making drastic changes, it's important to understand what's really driving your portfolio's performance. The key lies in understanding your biggest positions. In a diversified portfolio, you'll likely have a mix of different stocks, maybe some ETFs, and possibly some speculative plays. But it's your largest positions that will have the biggest impact on your overall portfolio value. For example, let's say you have 6 stocks that make up the bulk of your portfolio. Among these, you might have 1 or 2 that are significantly larger than the others. These are your real market movers. In our example portfolio, Meta, formerly Facebook, makes up a hopping $868,000 out of a $2.1 million portfolio. That means Meta's performance will have an outsized impact on the overall portfolio value. If Meta has a great quarter and sees its stock price jump, it could single-handedly push the entire portfolio to new heights. Similarly, positions in companies like Tesla, Amazon, and PayPal could also significantly move the needle if they perform well. The key is to keep a close eye on these larger positions and understand the factors that could drive their growth. But here's where it gets really interesting. Sometimes the stocks with the most potential for explosive growth aren't your largest positions yet. They might be smaller under-the-radar companies that have the potential to become multi-baggers. This is where a company like Honest, which we discussed earlier, comes into play. While it might not be a large portion of your portfolio now, its potential for significant growth means it could become a major contributor to your portfolio's value in the future. The takeaway here is that when your portfolio seems stuck, don't panic. Instead, take a close look at your largest positions and assess their growth potential. At the same time, keep an eye out for smaller positions that could become tomorrow's big winners. What industry or company do you think will be the next big disruptor in the market? Is it EVs, a consumer goods company, or something completely different? Share your predictions in the comments below. And remember, if you enjoyed this video, please hit that like button, subscribe to the channel, and don't forget to ring that notification bell so you never miss an update. Wait! Be sure to check out the description for some great items. Many people love these. I'm sure you will too. Catch you on the next video.